Looking at the Markets with David Modell. Welcome to Looking at the Markets with David Modell. Today, featured guest is Mr. Sean Emory. Mr. Emory is the founder and chief investment officer of Avery and Company. This is a firm that offers a variety of services, including market research to individual and institutional investors, along with specialized investment solutions. He's currently the author at themarketmeter.com, and that link is in the description of the video. Prior to this, he was the senior investment analyst and VP at CFG Capital for 5 years, a family office with over $1 billion in assets. Mr. Emory is also a prolific author and article writer at such esteemed websites as seekingalpha.com and seeitmarket.com. Mr. Emory, thank you so much for joining me today.
No, thank you, David.
Yeah, absolutely. And I just wanted to get a little bit on your background in finance, and I hear that there might be a sports connection in your past as well?
Of course, yeah. So I actually started playing baseball when I was young. Within that, I got very, attracted to fantasy sports, and I talk about that quite a bit. How fantasy sports is a good analogy of how the markets work in terms of you're buying players at a discount in theory, and trying to sell them off to your friends at a higher value, or when they've reached their intrinsic value in the height of their careers. And in theory, it sounds very similar to what you would consider good investing: buy low, sell high, and watch these companies or these players flourish. In terms of finance, I got a sense early on when, my father would have CNBC on growing up, went to college, and even in high school was very, very interested in the analytical side of it all. And throughout college, began working for the endowment as an analyst, and was at a hedge fund and also GFG Capital, where we were managing assets. But from there, I learned a lot in terms of being an equity analyst, being more of a global macro analyst at some of those roles, and got a good sense of so many different varieties of investing, where I think all of that has helped me know where I want to invest and where I don't want to invest, and what I'm best at and what I'm not so good at. And I think all that's I'm continuing to hone. It's never finished. If for all those investors out there, I think that's a forever takeaway, that you're always learning, and that's where I am today.
Yeah. And speaking of where you are today, just wanted to get a sense of, and we're going to talk about the market meter in a minute, but just wanted to get a sense of what it's like, the day-to-day grind of managing literally billions of dollars at an investment firm. I'm sure it's exactly like the Wolf of Wall Street, right?
Well, not quite in terms of some of the final occurrences, but it's a grind, right? It's you have a lot of responsibility on your hands, first and foremost. So for those that are in that position, you have a fiduciary responsibility, and I always say act as if it's your own capital. And honestly, if you wouldn't put your own capital, why would you put someone else's capital to work? Right. In those same investments or anything of those sorts. So the day-to-day grind is literally during earnings season. It's very intense in terms of trying to on all the different earnings calls, or listening to them thereafter because you missed some, or keeping up with, especially today, keeping up with the business side of it all, because now at Avery I own the business, so I have another addition to responsibility. But it's a day-to-day grind. It's continuing to analyze companies. You always get fundamental information maybe 6, 7, 8 times a year, and that's when you start to work on your current companies. And in the meantime, you're trying to find special ideas that will allow yourself to continue to make money at the end of the day. And that's what you're doing all day is trying to uncover ideas, deal sourcing, things of that sorts.
I like the sound of that. Uncovering ideas and capital preservation, of course, which I know, looking at themarketmeter.com right now, I know that capital preservation is what you're all about and what Avery and Company is all about. I know that because it says right on the front, I don't like losing money, period. And that's a great philosophy. It reminds me of a Warren Buffett quote: rule number 1, don't lose money. Rule number 2, see rule number 1. So there you go. What can you tell us about themarketmeter.com? I know there's an excellent blog on there, the Market Meter blog. And what can you, as well as the website, what can you tell us about the services that Avery and Company have to offer?
Yeah, so the marketmeter.com actually started years back in terms of a personal blog. It allowed me to speak my mind, very simply put, but also take whatever's top of mind, right? And whether it's a company specific or a market specific, and share my thoughts on it. So that's really what you get there is top of the mind type of topics and ideas. Avery is a investment firm, so we are someone that focuses a great deal of attention on research, everything from company specific to more macro, and taking all that research that we compile in-house and generating, again, it all comes down to unique ideas, but in order to come up with a unique idea that again, preserving capital by way of understanding what you're investing in, you have to do a ton of research behind that to get to your end conclusion. So again, research firm that comes up with ideas and then invest those within several of our portfolios.
Sure. Absolutely. And wanted to talk about, speaking of your portfolios, I'm not going to ask exactly where you're positioned right now, but I am curious as to what you're bullish on and bearish on at the moment. 2017 is almost halfway over now. It seems like a frothy or toppy market. Should we be, again, this is not investment advice in this video, but should people be in equities right now, or should they be hedging with something else?
Well, look, so I'm not a big believer in hedging just for the purpose of, if you're hedging, you're unsure. That's my general philosophy, and if you're unsure, then you probably shouldn't invest, period. But we're looking for big ideas, big themes that are transforming either niche markets, larger markets, and within that, I mean, some of the areas just more broadly, and it was we gave our 2017 themes and beyond report at the beginning of the year, and one was the transformation of legacy type of industries and adaptation there, right? So think of insurance, think of payroll. If you just look inside of corporations today, and even, I mean, a couple of years ago, there was very old school, archaic systems in place that need to be transformed, and we've been looking to discover which companies are transforming that. A company, and again, it's not a recommendation, but a company that we continue to look at is a company called Guidewire that's helping the insurance industry turn from a more archaic, everything done internally and ton of paperwork to a more digital platform. If you look at companies like, and I've been pretty public in terms of just talking about the company, Electronic Arts, which the whole gaming industry is becoming much larger in scale, but also transforming into a more digital platform where margins are expanding at a rapid rate for all the big players, whether it's Activision, Take-Two, Electronic Arts, are all seeing the same thing. Go look at their margins and see how they've expanded. But in order for you to know that, you had to start following these stories and understand what is really happening. and what's going to continue to happen in some of those stories. So that's really where we're looking. Those are just brief ideas in terms of examples of the themes that are taking place today. But there's so many other industries where that's happening. And again, we're looking for companies that are extremely sticky and have some sort of moat around the business. So good luck trying to compete with again, some of those gaming companies, content creators that as those player networks develop and grow, it's going to be harder and harder for competition to step in. Now they've added live services, so the revenue model is much more reoccurring. And then even like a Guidewire, I mean, regulation, governmental type of necessities are required, and languages if you want to go in scale in terms of worldwide. And there's just not that many players out there that can compete with them, and all the different insurers are moving in that direction. And that's why if you look at Guidewire, they're guiding to 15 to 25% revenue growth over the next 5-7 years. I mean, because the transformation is real, and it's going to take time for all of it to occur. But at the end of the day, that's what we're looking for, these big ideas with huge runways.
Yeah. Interesting. You mentioned looking at guidance. What are some other fundamental aspects of a company that you look for if you want to decide whether a company or even a whole sector is strong enough to put your capital into it?
Yeah. So it really starts off with like those economic moats, right? Where maybe it's hard to switch. It's hard to get in the network of what they're doing. That's so special. That's the foundation of it all. But when we're starting to look more specific at companies, I mean, some of the things is how levered are they? If they wanted to, could they pay a dividend? They don't have to pay me a dividend. I'd rather them reinvest that capital and make more money on the market opportunity. But it's the quality of their balance sheet, because the last thing you want is for your company to run into cash flow problems. And if you have no debt, I mean, that becomes something that is not as much of an issue. But at the end of the day, you want some debt because you want them to grow at a quicker rate. But, I mean, just different factors. We look at free cash flow. We're looking at margins. We're listening to management teams across the sector to see who's saying what and whatnot. But again, within those different areas, we're looking for one company. We're looking for that one star that we think is going to be the winner, and it could be several winners, because that's typically what happens. But we want the winner, and within that, again, it comes down to quality, it comes down to growth, it comes down to valuation, and all those things have to be analyzed and assessed before the investment occurs.
Yeah, so many things to look at. And speaking of looking at things, sure, we look at the fundamentals always, but how about the technical side of things? Are you a chart guy on any level? Do you look at charts, and are there any indicators that you like to look at in particular?
Yeah, so we do look at charts. Obviously, so the beauty of the private markets is the fact that you don't have to look at charts and whatnot. But the beauty of the public markets is there's liquidity, or for the most part there's liquidity, depending where you're at. But with that liquidity comes obviously the lack of benefit, or the zero benefit of having price moves every day. You're getting reassessed every second of the day. So focusing on technicals is important, especially at the entry levels. We want to start off on the right foot always. And in the short term, again, companies can continue to move lower, and why move into something that's trending significantly lower, where you want to see a base start to form, settle in, momentum indicators like MACD and RSI. Very simple stuff, but using those on various time frames, whether it's monthly, weekly, daily, looking at moving averages. Again, we're focusing on support, trend, within names that we want to own fundamentally. Last thing I want is to own something that is down 20% because a fundamental news broke and I don't know anything fundamentally about it, and I wanted it because I saw RSI tick higher and MACD tick higher and all these other oscillators tell me that this was a buy, but at the end of the day, news broke that I can't control and I don't know anything about, right? So if it's 19% lower on something that I think is excessively much more valuable, then in theory I should be fine with that.
Makes sense. We're combining the fundamentals and the technicals, but the fundamentals definitely have to be in place. Wanted to talk
100%.
real quickly. Yeah, wanted to talk about precious metals, if you don't mind, gold and silver. I'm looking at both of those. Are you looking at them right now, and what are you thinking?
Yeah, so gold and silver. I mean, I'm not necessarily a precious metals guy, but when it's just been interesting over the last couple of years how we've seen the rise and then fall and then rise again of something like gold. And over the last several years, we've seen inflation settle in and then pick back up, and then gold become more demand towards it. I mean, just in general for both, I don't invest in either of them. They're input costs and so many different factors. But again, it comes back to my theory of how I look at gold and silver and how I look at investments in general. I like cash, right? I mean, I like to analyze things based on cash. Because as an investor, when cash comes in, you can reinvest it and whatnot, as opposed to something like gold and silver, which they have some use cases, but less use cases in terms of some of the other things I'm talking about. But it's just interesting over the last 3 to 5 years to see how high it's gone and how low it's gone in such a short period of time, based on different theories, whether it's excessive balance sheets for the Fed, excessive balance sheets around the world, and then overlapping that with something like a Bitcoin or all the other cryptocurrencies, and seeing all these different movements combined. It's interesting. That's kind of my view on it all.
Sure. And finally, because I know your time is valuable and I appreciate you stopping by today, I just want to talk about how we protect ourselves. Are you a stop-loss kind of guy, protective put options? What is your, or do you just ride it out? What is your approach to when things turn bad?
Right, so I'm willing to ride it out, right? If you get hit today on a one-day move, August 2015, when China devalued the currencies, I mean, things like, I don't know, Netflix was down 20% in the morning, and if you own Netflix for fundamental reasons, I guess you have to ride it out. But I don't protect myself in terms of hedges. I do use put options in terms of writing them to move into some positions. So in a sense, I'm hedging my entry point, maybe, if you will, by, I don't know, 3, 5, 6, depending on what kind of premium we're getting and how low we can go. But it's not an outright hedge of any sorts. We do, again, look at technicals. So I am careful and I do pay close attention to technicals in the sense of, I mean, if we're making highs and all the different momentum indicators of such are telling me, hey, look, this could have a serious pullback and support isn't anywhere close. That could be something where we simply go to cash, and maybe we go to cash and we start selling those put options to buy at another 6-7% lower, still holding the long bias, but ensuring that we can absorb some of the what I would consider foreseen volatility in the future, and you're never going to get it perfectly right. But again, if you're trying to protect capital, then if you see some signals that are sending messages where, hey, we're going to have a significant pullback, then I think you have to listen in the public markets and try to protect some capital.
Makes sense. I really appreciate this time you've spent with me today. TheMarketMeter.com is the place to check out the Market Meter blog, and there's so much great content in here. Also, to check out Avery and Company, people should go to www.avery.xyz. Not .com, .xyz. Yeah, which is interesting, but cool. And if people wanted to check you out on social media, can they do that, and how would they do that?
No, of course. I mean, it could be StockTwits, it could be Twitter. Twitter is it is underscore Sean David. Sean is Sean David. So underscore Sean David on Twitter. I mean, just feel free to message me anything you want. Got a ton of good followers on there. A lot of them are active with me, and we just get in discussions of different stuff. But I post a lot on there. I mean, obviously Twitter is like a micro blog, right? So some of my short-term ideas on of what I'm thinking and earnings reports and things like that typically go on my Twitter, and it's a good place to interact with everybody.
People should be checking that out right now. Why not? Check them out on Twitter. Check out themarketmeter.com. Sean, I really appreciate your time today. Thank you so much for joining me on Looking at the Markets.
No, David, thank you so much, and glad to be back at any time.